What if I told you that trading isn't as complicated as most people make it seem? Would you believe me? I can prove it to you. I have placed thousands of trades, made all the mistakes, and in this beginner series, I'll break down the basics, common mistakes, and strategies to help you trade with confidence. I have summarized all the lessons that I learned along the way, and I will share with you everything that you need to know to start your trading journey and turn into an income generating machine. All without needing any money. This is the series I wish I had when I started trading, so if you are ready to fast track your trading journey with 5 years worth of insights, condensed into short actionable videos, stick around, take notes, and let's get started. Now, the first part of this beginner series will be an introduction to trading. And it doesn't matter how much experience you have or may not have in the markets, I think that this lesson can help you, as sometimes it's also about the golden nuggets that are shared in between the lines. So trading involves buying and selling financial instruments such as bonds, commodities, currencies, or cryptocurrencies to make a profit. So if we have a look at this, if a trader expects a price to rise, he can buy an asset and profit from a market that is moving to higher prices. But at the same time, and this is a very common misconception, we as traders can also profit from markets that move to the downside. This is called short trading and something I will cover on further videos. Okay, so we can profit if a market goes up, but we can also profit if a market goes down. And now let's have a look at typical types of trading. We have different assets that we can trade. We can trade stocks. Stocks refer to shares of a company which we can buy or sell to make a profit. Besides that, we can also trade forex. So forex could be a pair. This is a currency pair like euro against the US dollar. At the same time, we can trade commodities such as gold, oil, or silver. So here we can see the gold futures. And besides that, we can also trade cryptocurrency. A very famous example for this is obviously Bitcoin. Our primary goal as traders is to make a profit by capitalizing on market movements. Our secondary goal would be capital preservation. This could be protecting the trading capital from significant losses, but also risk management. This refers to balancing potential profits with potential risk, which in trading we call risk to reward. And for that, we have an inbuilt risk to reward tool in TradingView that we will also cover along the lines that is automatically calculating our risk to reward. So if we look at a trading setup like this on Bitcoin, it's going to show us a risk to reward ratio of 7.86. This means this trade aims to make 7.86 times the amount of risk that we are taking in this particular trade. Now you can see when I adjust this risk management tool, you can see that this is obviously going to change. How can we as traders achieve these goals? And our primary tool is the technical analysis, but also fundamental analysis to make informed decisions. Now, if we go back to TradingView real quick, I want to share with you just one simple tool of technical analysis that made it possible to predict a rise in the gold market of over 6%. Here I was simply looking at a previous supply zone. Now don't worry, this is something I will cover along the way, But this is a very simple yet extremely effective technical tool that allows us as traders to capitalize on a nice price increase like we've seen here. That was all made possible by being able to use and identify these technical analysis tools to identify good places to buy an asset. Now, the next thing we have to do is look at strategies. So we have to develop, but also follow our trading strategies. So the next thing we have to look at is the difference between trading and investing. So one of the main differences is the time horizon. So as traders, we are mostly focused on short term. This can be minutes, hours, or days. Our objective as traders is to make quick profits from short-term market movements, which we can predict or try to predict by using technical analysis. The activity level of a trader is high-frequency buying and selling. This means that within a short period of time, a trader can take multiple trades, while an investor is more often than not positioned and is going to hold on to that position for a very long time. Risk. As traders, we generally have a higher risk due to market volatility. We as traders are exposed to the low time frame market volatility, while an investor can just stay in an investment and don't really care about the low time frame price volatility. So now let's have a look at the characteristics of investing. The time horizon is long term. It can be years or even decades. The objective as an investor is gradual wealth accumulation through long-term growth. The activity level is low frequency buying and holding. So let's have a quick look at TradingView for this. If we look at a very high time frame chart, an investor might buy an asset down here in the year of 2015 and hold on to that exact same investment all the way up to here till 2024. A trader, on the other hand, would take multiple trades. He can take a long trade, aiming for higher prices to come down here. Then he can take a short trade, go into a new long trade, then take another short trade, take another long trade, and take another short trade up here. So while an investor is just holding on to one single investment, a trader tries to capitalize on different and multiple market movements. The risk is generally lower due to the focus on the long-term trend. An investor can sit out low time frame volatility and hold on to a long-term investment. Trading is a dynamic and active approach to making profits in financial markets. It is offering many opportunities, and that's what we like about trading. The goal of trading is to profit from short-term market movements while managing risk. As traders, we can even refer to ourselves as risk managers. I'm going to go through that throughout the beginner series, but risk management is the most important thing in trading to ensure that we can have a long sustaining career in trading. So, trading and investing differ primarily in time horizon, activity level, and risk. So the next steps for us will be to understanding market analysis and developing a trading strategy. So see you in the next videos, and I hope you enjoyed and could take something away from this series. Trading can be the most rewarding journey, but also the most frustrating. Trust me, I've been on both sides. When I started trading, I felt completely overwhelmed. So many markets, so many assets. Where do you even begin? Here's what I learned. Having a basic understanding of financial markets is essential if you're serious about trading success. That's why in today's video, I'm cutting through the noise and giving you a clear, beginner-friendly introduction to financial markets. Part 2 of this beginner series is covering the introduction to financial markets. So let's jump into the charts and ask ourselves the first and foremost important question when it comes to financial markets. What are actually financial markets? So the definition is that financial markets are platforms where buyers and sellers engage in trading financial assets. So here we have stocks like Tesla, bonds, commodities like gold, forex like the euro USD pair, or cryptocurrency like Bitcoin. Our trader's perspective is these financial markets provide opportunities to engage in buying and selling assets to make a profit. Let's now first cover the basics of trading stocks. So stocks represent ownership in a company traded on stock exchanges. In further lessons, I'm gonna explain what different financial assets we can trade so we don't have to own a stock but still are able to trade a stock. But that will come in the next lesson. So when it comes to stock trading, we have opening hours. So if we look at this on TradingView, we can see that currently we're trading in pre-market. This time is given in New York time zone, as the big exchange is always the New York Stock Exchange. So we can see in New York time, the pre-market is trading from 4 a.m. till 9:30 a.m. At 9:30 we will get the market open. So if you're in UK time, this will be at 9 a.m. UK time. This is where the pre-market trading starts, and we get the NY open, so New York open at 2:30 p.m. So the market will be open from 9:30 a.m. New York time till 4 p.m. New York time. Okay, and then we have a post-market, which is from 4 p.m. New York time till 8 p.m. UK time. And then we have the market closed. And then this process just repeats. So these times are not going to change, and it will be the same every single day unless we have a holiday in the US. So we can day trade stocks. That means capitalizing on opportunities that are presented in an intraday basis. We can also participate in swing trading. That means we increase the time frame we are looking at for taking trades and also holding trades. So if we're looking at swing trades, we want to get into a trade and hold that for a couple of days, maybe even weeks or months. The most local time frame or way of trading is scalp trading. So on the stock market, we can also capitalize on scalp trading. That means we are on the very low time frames and only aim to hold a trade for a couple of minutes, sometimes even seconds. As we already covered, as traders, our main or primary focus is always the technical analysis. So when it comes to stock trading, our primary focus is on volume analysis. We can just use some simple indicators on TradingView for the volume profile. This is something I will cover in further videos, but we can use volume analysis, simple technical analysis, tools like supply and demand zones, or we can simply look at price movements using market structure. So bonds are tradable debt securities issued by entities. Here we can see the 10-year T-note futures. Okay, so the market is, we have two market types. That is one, the primary versus the secondary markets. So the primary market is where bonds are issued and sold directly to investors, while the secondary market is where existing bonds are traded among investors. This is what we can see here. So at the same time, we can look at trading strategies, and that differs a little bit to trading stocks, cryptocurrencies, forex, and all these types of stuff. So here, people are interested in interest rate speculation. That means profiting from changes in bond prices due to interest rate movements. That already suggests that as bond traders, we have to keep a primary focus on economic data releases. So another trading strategy is the yield curve analysis, and that means understanding the relationship between interest rate and different bond maturities to make informed trading decisions. The key indicators we would use are interest rates, economic data, as I already said, and credit rating. So for me, I'm already going to say that myself, I'm not too interested in trading bonds, but this is something one can do if interested in trading bonds. So the next thing is trading commodities. And one very popular example for this is trading gold futures. So when it comes to trading commodities, we have to look at the definition, and that is commodities are raw materials or primary products on exchanges. In this example, I'm looking at gold futures. By the way, this is just the asset I choose to trade when it comes to commodities like gold. In the next lesson, I'm going to cover the different assets to trade, so you will understand all the different assets we can trade and capitalize on as traders. When it comes to commodities, we can trade the spot market and futures. Okay, when it comes to spot, it means that we actually have ownership in the underlying commodity. So that means you can buy gold and keep it in a safe, for example. That would be owning the actual underlying asset, but you can also buy spot and keep that on an exchange. Okay, if you just buy a ETF of the gold, for example. Okay, or we can trade gold futures. That is my favorite asset to trade when it comes to gold trading. For trading strategies, we can think about futures trading. That has the lowest fees. We can look at options trading and also spread trading. A futures contract means that we have an agreement to buy or sell a commodity at a predetermined price at a specific time in the future. Options contracts give you the right but not the obligation to buy or sell a commodity. And spread trading refers to simultaneously buying and selling related commodities to profit from price differences, for example, on different exchanges. The key indicators for trading commodities are supply and demand factors, geopolitical events, and also weather patterns. Another market we can trade is the forex market, and that is the largest financial market where we can buy and sell currencies like the euro against US dollar. And this market is particularly characterized by its high volatility, and also if we trade CFDs, this is a very well-known asset to trade when it comes to the financial market of currencies. I will cover this financial asset next time, but this is traded 24/7. So we get 24/7 trading access with currencies. And we have different trading sessions. So this is London session, New York session, and Tokyo session. So this will be the Asia session. This is very important to note when it comes to volume characteristics. So we always have to keep in mind that New York trades the highest amount of volume. So whenever we trade, we should primarily focus on the New York trading session. However, we can still capitalize on price movements in London session or even Tokyo session. We just have to be aware of lower volatility. When it comes to key indicators, we are looking at technical analysis, volume analysis, economic indicators, but also central bank policies. For that, it's once again important to be aware of economic data releases and also political stability. So let's now summarize what we have learned in this lesson and look at key takeaways. So financial markets offer several instruments and assets to trade. For every personality type, there is a matching asset to trade. And that is what's so good about trading. No matter your time zone or your preference for whatever asset, you will find the right asset to trade. And that meets your criteria and your own personality. Trading each of these assets offers potential for significant profits, but requires a deep understanding of market dynamics and strategies. What I learned in my trading career is that this last part is so important. We have to understand market dynamics and also strategies, and that comes with time. So what I want to do with this series is break down what I have learned in my 5 years of experience and share with you the most important things that I've learned. So in the next lesson, I will be covering the different assets to trade. So see you in there, and I hope you enjoyed this video. Alright, let's get real. Starting your trading journey can feel quite complicated, right? What software do you need? What hardware do you need? And which broker would you even trust? Don't worry, I've got you. In today's video, I'm breaking down the trading setup that I am using, from the brokers that I use to the trading, charting, and order flow software that I use every single day to make trading simple and efficient. Having the right setup isn't just about convenience, it's about setting yourself up for success from day one. Stick around, because once you've got this foundation down, you can focus on what really matters, and that is making moves in the market. So let's get into it. We've already covered a lot you need to know for your trading career. But now we have to move on to the setup introduction, because a very important question you have to ask yourself is, what do you actually need to start trading? And it is essential to have the right tools and environment, as that can significantly impact your trading success. So there are two key components you need to know. And that is, you need a hardware, which is the physical setup, but also a software, which is your trading software, charting software, but also brokers. And I am going to give you an introduction into what I am using, which you can simply replicate to have an easy and efficient trading setup. So, when it comes to hardware requirements, we need to be aware of a couple of things. We need a high-performance computer for smooth execution. We need fast processors, but also an adequate RAM. At the same time, we need multiple monitors. So for me, as you have seen, I'm using 4 monitors. I'm not saying that is what you need when you are starting your trading journey, but when you are getting to that more experienced stage, that can be quite helpful to have a good screen estate, because I'm using TradingView on my main monitor. On my 2 other monitors, I am using order flow software, and then I'm also using one monitor which is for Discord to post updates. So we also need a reliable internet connection. That means a fast and stable connection to avoid delays when executing trades. Okay, so let's now move on to the trading software. I'm going to give you a quick overview of what you can do in TradingView. Over here, you can obviously use all the drawing tools that you find on the left side of your screen. Okay, you can flip between different assets and do your technical analysis for each and every single asset you like to use. When you go over here on the bottom left, you can even type in new assets that you want to look at. So, for example, let's choose DOT against USDT. We can add that and have a look at my already existing drawings. So this is the drawings that I did last week. I can always find that over here, which I already drew out on TradingView. At the same time, we have an inbuilt trading panel. In one of my further lessons, I'm also going to explain the paper trading, or how to connect a real broker to your TradingView. And here we can see we have a selection of various different exchanges we can connect to TradingView, making this not only a nice charting software, but also an actual trading software. So we have almost like a one-stop shop when it comes to TradingView. And I highly recommend using TradingView for your charting when you're just starting out. Now I want to move on to the order flow software. So we have 3 options that I have used myself. I am mostly using ATAS, but we also have Quantower and EXO. All of them are very similar, but they do have some smaller differences. And for each and every personality type, there is the one order flow software that suits you best. For me personally, that is Atas. And I will give you a quick overview of what I am mainly looking at when it comes to order flow. So let's have a look at my Atas setup. And don't worry, you don't have to understand everything that I'm going through. For these complex templates, we do have a full course over on our website. So here we are looking at my main chart on Atas. This order flow software has the advantage that we can even connect our broker to Atas and trade directly via Atas. I'm going to show this over here so I can open the trade panel, and what I can do here is market buy, market sell, or I can even create limit orders such as here. The market is not open, so I can't do that right now. Yeah, we can select our predefined stop loss and take profit. We can also adjust the trade, close the trade, or cancel limit orders. So that is a very convenient way to trade via your order flow software directly. So just to give you a sneak peek, here we can look at my right screen where I'm looking at order flow templates as well. So order flow templates such as the volume profile or the 5-minute order flow, where I created a full strategy using that template. We can also look at the 1-minute order flow on my left screen, or the CCTR, which is one of the templates we over at Chart Champions like to use. And then we have a one-stop shop where we can do the charting and order flow analysis in one place, and also executing the trades right there. All of the other order flow softwares that I already mentioned are very similar, although they have its own characteristics and might look slightly different. Now that we know which charting and also order flow software we use, we have to make a decision on the broker that we use for actually placing our trades. So for that, I'm going to give you an overview of 3 brokers, each for its individual purpose. Here I want to look at a broker for trading crypto, which is Bybit. This is one of the brokers that I use myself and I have used for over 5 years. When it comes to futures trading, I want to give you an overview of AMP, because AMP futures can also be connected to Atas. And when it comes to CFD trading, I can recommend forex.com. So all of these brokers are brokers that I have tested myself for several years and are the ones that I trust myself. So now let's have a quick look at how the platform Bybit looks like. And here we can see that we have several assets we can choose from. So we have an entire selection that is available on Bybit. We can trade BTC or Ethereum against USDT, but also we can trade the inverse perpetual, which is BTC against USDT. And the difference is that you need to hold the underlying asset. When it comes to USDT pairs, we only need USDT in our trading account. So when we have a look at this, we can see an inbuilt TradingView tool where we can actually do nice drawing as well. So that is what we already have in TradingView. But over here, we can also execute trades. So there's the option of using limit orders, but also market orders. We can choose a quantity and take a trade. We can trade long trades or short trades. What is really nice about the website of Bybit is that we also have the markets overview. Over here, we can select by assets that had a lot of volatility, or we can select by assets that have a lot of volume being transacted in the last 24 hours, which makes us aware of the assets that have some very interesting low time frame trading opportunities. So if we go back to here, this is the main panel that you would be using for trading when choosing order flow. We can also see the order book over here to see if there is a good liquidity in the markets. Next, I want to mention a broker that I used for CFD trading. For this, we can go back to TradingView and choose an asset that is tradable via CFDs on forex.com. If we look at TradingView down here, we can see that we have the possibility to connect forex.com. Now, forex.com is a popular broker offering CFDs on a variety of assets, including commodities, indices, and also currencies. We have the key features of competitive spreads, a wide range of assets, and advanced trading platforms like MetaTrader. When I'm trading on forex.com, I choose to use TradingView and connect forex.com via TradingView, as that is a very simple and efficient approach to having the charting and trading tool in one space. What's great about forex.com is that it's well regulated. One thing to note though is that CFDs involve high leverage, so it's essential to understand the risks involved. When it comes to futures trading, as I already mentioned, I am using AMP futures. For this, we can go back to ATAS. This is where I would connect my AMP account to this Autoflow software to be able to trade via Autoflow directly. When it comes to AMP, its key features is that it has low margins. So in comparison to a CFD contract, as I explained in the previous video, we have much smaller fees. So for example, if we look at the S&P 500, the futures contract would be the ES contract. And for a full round turn, which is the opening and closing of a position, we only pay $4 in fees. That is a very, very, very low fee considering the position size that we have when it comes to trading a single mini contract. At the same time, we have an access to a variety of future exchanges. We use the CME and multiple trading platforms. As I said, I'm using ATAS as my primary platform. At the same time, we have to keep in mind that futures trading is highly leveraged. So understanding contract specifications and risk is very crucial. So to have a full and complete trading setup, we also should look at supplementary tools. So one, for example, is an economic calendar. For that, we can have a look at TradingView, and that one has an inbuilt economic calendar. We can have a look at all the important economic data releases for any specific day. At the same time, we should always have a news feed open. So this can be a real-time financial news platform to track market moving events. This can be Bloomberg, Reuters, or something like Financial Juice. And there's one more thing I want to bring your attention to, and that is the importance of having a trading journal software. I am personally using TradeZella, and this is the one that I've been testing for a long time and I like the most. So here we're looking at one of my journals from a AMP futures account that I'm using for day trades. So this is one of the accounts I'm not using every single day and rather focus on taking maybe 1 to 5 trades a week, but nothing more than that. So this is one of the sub accounts that I'm using. And what we can see here is our net P&L. We can also get analysis on the trade win. That means for these 2 weeks, I've only taken 7 trades. 5 of them wins, 1 break even, and 1 loss. That is leaving me with an 83.3% win rate. The profit factor, which is the key thing you should focus on, is the risk to reward. That means my reward is 3.3 times the amount of risk that I'm taking. So for example, when I'm risking $100, I'm at least aiming for, or this analysis shows that I'm at least making $330 with this trade. You will also get your daily net cumulative P&L. This is always good to see and follow where you are and how your account is growing. Now down here you will get a selection for every single day and you will see your each and every single day's performance down here. I myself recommend every single one to use a trading journal, especially in the beginning. This is what can set you apart from most traders who don't like to put in the effort and don't use a trading journal like TradeZella. Now, if we have a look at a TradingView again, we can summarize what we've learned and also think about one more thing, that is creating an efficient trading environment. So when it comes to ergonomics, we should have a comfortable chart and desk setup for long trading sessions. Because I have to tell you that trading involves long hours in front of the screen, so we should be as comfortable as possible. We should only be focused on what's important, and that is the charts. We should also, and that is something I can highly recommend, establish a routine. So I for myself am following a very strict daily routine that sets me up for the trading day ahead. There shouldn't be anything that is distracting you, and if there is something that's distracting you, it is probably better to take the day off and come back the next day. So, to summarize, a proper setup is crucial for efficient trading. And investing in the right hardware and software will improve your trading experience and decision making. So I hope you enjoyed this lesson and see you in the next one. Alright, let me ask you this. What's the difference between traders who struggle and traders who become millionaires? It's not luck, it's technical analysis. With Bitcoin hitting new all-time highs, Nasdaq hitting new all-time highs, and the entire crypto space exploding, there's never been a better time to take trading seriously. In these moments and these opportunities, average people can become millionaires if they have a proper plan. Last year, I shared setups like AR, which had an increase of 500%, Sheep with another 400% increase in price, and very recently I shared Link with another 200% increase in price, all using very simple technical analysis. In this video, I'm breaking down everything you need to know to master support and resistance and eventually be able to spot game-changing setups yourself. So let's now finally move on to what we traders love so much, and that is technical analysis. In this lesson, I'm going to give you an introduction to technical analysis. And we have all seen all these fancy tools. When we look at TradingView, we can pull fixed ranges, we can look at Fibonacci pulls. We also have a variety of indicators like we can see here, the 100 SMA. But what actually is technical analysis? So the definition is that technical analysis is the study of past data, primarily price and volume, to forecast future price movements. Hereby, the focus is always price charts, historical data, and that means we can see historical data for a variety of assets. Here we're looking at Bitcoin, and we can see we get a lot of historical data here on Bybit, even starting in the year of 2018. Okay, so we have other traditional markets that have even a lot more historical data than this. Besides that, we look at patterns, I myself love this pattern. It's previous supply and demand, for example. So we look at how previously price reacted to supply and demand zones to try and make a decision in the future. So here we can see this previous supply zone has been flipped into demand. We can have a quick look at ES, which is doing the exact same. We flipped supply into demand. We've seen the same pattern up here. Supply has been flipped into demand again. And that was able to be identified with knowing historical price data, where we did that many times in the past. Here we flip this previous supply zone already into demand, which for us traders offers a great opportunity to take a trade. Yeah, what are assumptions of technical analysis? So we do have a couple of assumptions which are good to know. And no matter your stage of trading or where you are at the moment, I think that anyone can learn something in this video. Maybe it's even the assumptions of TA. So we have an assumption that market actions discounts everything. And that means all known information is already reflected in the price. And that is based on one of the core principles of the efficient market hypothesis. Okay, so that suggests that asset price reflects all available information. And that is very important to understand when we look at technical analysis. We also assume that price moves in trends. So price moves in trends that can persist over time. So let's have a quick look at Bitcoin once again, and we can see very recently we are trading in a nice uptrend. We can do that on the 4-hour time frame, and moving in a trend means we are identifying if price is trying to go up or trying to go down. And here we can very simply see that price is making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and so on and so forth. So this is a very clean trend we are still trading on Bitcoin. Besides that, we assume that history tends to repeat itself. So patterns often reoccur due to market psychology. This is something I will touch on in later videos as well, as the psychology in trading is a very important and key factor as well. And one of the key reasons for us to look at technical analysis is that we get real-time insights and we can make very quick decisions based off technical analysis. So here we can see we can go down to low time frames such as the 30-minute time frame and get insights into every 30-minute auction, and that allows us to make a quick and informed decisions on every single time frame using technical analysis. For example, down here, this is a great example. We have been trading or looking at a low time frame channel. This is the channel high, this is the channel low, and we've seen an SFP. We can see on the 30-minute time frame, we get real-time data. We see the market is trying to break the channel low. However, it failed to do so. It failed to get follow through. For us as traders, we get instant data on this and we can make a quick decision to be looking for a long trade down here, as this auction to the downside failed to get follow through, and we as traders can anticipate this price to rotate to the other side of the market. In this instance, we can even see that we have done the exact same scenario on the opposite side of the range. So we have SFP'd the previous range high. Once again, on the 30-minute time frame, price failed to get follow through. We got our SFP entry confirmation and were able to take that short trade and at least hit a take profit 1 on the middle of the channel. Okay, so this is why we as traders are able to make instant decisions just by looking at the data that is presented to us. And we can also identify pretty simple entry and exit points. This is a major advantage for us as traders as opposed to investing long-term into an asset, because we can look at the actual candle data. We know exactly where to put our stop loss, and from using technical analysis, we exactly know where to take this trade into. For example, it's a very simple tool. It's looking at a horizontal channel, and that means at the range low, we look for long trades. At the range high, we look for short trades. The take profit is always the middle of the channel. So here we can see long trade, hit a take profit 1, hit take profit 2, and the short trade, hit take profit 1, and then we were stopped out at break even, since after hitting take profit 1, we would always de-risk that position. So this is the power of using technical analysis just by looking at these simple tools. And if you only learn that trading a range on crypto, or actually on every market, is an extremely powerful tool, you already learned something in this video. And that being said, let's have a quick look at a comparison to technical analysis with fundamental analysis. The technical analysis focuses on charts, trends, and market psychology. For fundamental analysis, we focus on company data, financials, and intrinsic value. That is something we can include for our technical analysis, but we don't have to, especially if we're trading on the lower time frame. We don't necessarily have to do the fundamental analysis, because all the data we need as traders is already given in the chart. And technical analysis is much quicker as opposed to analyzing the company data for an entire year, for example, to make a decision, and therefore preferred for short-term trading. And for a conclusion and the next steps, technical analysis is essential for short-term traders, helping them make informed decisions based on price action. And what I want to do next is look at support and resistance and show you the levels that can give you an insight into the markets, what to look for, and how to identify these setups yourself. So after deepening the understanding of what technical analysis actually is, let's have a look at some support and resistance tools that help us spot high confluence areas of support or high confluence areas of resistance every single day to profit in these markets. First and foremost, it's important to understand what support actually means. And support is a price level where a downtrend is expected to pause because there is demand coming in. This down here on the channel low was an example of a support zone. And we can see this support held, we had demand come in that pushed price to the upside. Conversely, a resistance zone is a price level where an uptrend is expected to pause due to selling pressure. And this right here is a good example. We've had this buying pressure that pushed price to the upside, and up here we clearly got selling interest and sellers trying to push price lower. So what is actually the psychology behind support and resistance levels? So buyers see this level down here as a good buying opportunity, and they try to push price to the upside, expecting their position to increase and with that make a profit. For resistance levels, sellers view this level as a good exit point, which is increasing supply or even a good point to short trade a market. Because as I previously explained, for us as traders, we don't need to see the markets go up forever. We can long trade, and that means expecting higher prices to come, or even short trading, meaning we expect lower prices to come, and we can even profit from that. So let me now give you a couple of insights into what technical analysis tools I like to use every single day. And for that, we can once again look at historical data and try to translate that information into the new data that we're getting to make an informed decision. So for us as traders, it's always very important to look at high time frame highs and lows. So with that, we can look at a high time frame chart such as the weekly time frame here on Bitcoin. And if we mark out a previous significant high, which was our old all-time high at 69,182, we can see that even that was 854 days later, this high has been a very significant point in the chart where price was again finding supply and traders took profits or took short trades to defend that level. We can see previous high still acting as resistance even years later. Now we can look at the same principle a little bit more local. So a previous low can be a very good level of support. If we go down to the lower time frame and check this price action right here, we can see how well respected this old level has been over the next couple of weeks. After price was retesting this level for the first time, we had another auction to the upside. We then got the perfect retest of this previous low, and we formed this higher low, which led to another subsequent move to the upside. Now, for identifying these levels, it's very important that we focus on levels or highs and lows that were significant lows, after which we have seen a nice and impulsive move away from that level. We don't want to look at any levels in between because that is too insignificant. We want to look at very significant points at a low of a range or at a high of a range, as I was showing with this previous all-time high on Bitcoin we have seen up here. Besides that, we can look as ranges. So whenever a market is not trending, that means not forming higher highs and higher lows or lower highs and lower lows, price is typically forming a range and consolidating in a range. So for that, we can use our channel tool in TradingView and analyze this price action here for the previous all-time high range. So we can see even weeks later, price was respecting this range low. So we anchor it from this high, connecting to this high and this low right here. So this subsequent move to the downside found another support at this previous range low. And then we can even see that after weeks or years or months of price action, price is still respecting old channels. And there's a saying that we as traders should never delete a well-respected channel. And I can 100% confirm this statement. As we can see here on Bitcoin, this previous channel acted as resistance. Then we got the reclaim, and finally we are getting the break out of this previous channel. So we already have significant highs, significant lows, and channels. But besides that, there's one tool that I really like to use, and that is what I already mentioned, which is previous supply and demand zones. So for this, I was already showing a high time frame example on the S&P 500, but this is also applicable to the lower time frames. Or let's now do this for Nasdaq, for example. We can see this high time frame, previous supply zone, was flipped into demand, and this bounce was then rejecting the previous demand zone. So the same theory, just vice versa. If we have a previous demand zone, which is characterized by buying interest stepping in around this level, losing that level, and then retesting this at a later time. So we can see previous demand flipped into supply. But now let's have a look at this on the lower time frames and see how well this is respected even on lower time frames. Here we have a great example on Nasdaq. So here we clearly had previous buying interest step in. This is identified by wicks into the level. So we've got 1 wick into the level, 2 wicks, 3 wicks into the level, and buyers were trying to defend that level. At some point, however, this previous demand zone was lost and backtested. So this previous demand zone was flipped into supply for another subsequent move to the downside. A few days later, Nasdaq managed to reclaim this level and flip this, which is now considered to be a supply zone, back into demand. So this is one of the most important tools I use on a daily basis, which is called supply and demand flips. This is what I teach over on the website. I have a full course on supply and demand zones, how to identify these levels and how to trade them. So besides these levels, we obviously have our wonderful volume analysis as well. So for this, I want to have a look at this recent range that was formed on Bitcoin. So when we look at volume, we also have simple indicators such as the fixed range volume profile. We anchor it for this start of this consolidation range and pull it across to current price action. Now this gives us insights into where 70% of this entire volume in this range was traded. And that is indicated by the value area high, which is this orange line, and the value area low, which is this orange line down here. And we can already see how well this value area low was respected. Now this red line is the point of control, and that means this is the highest amount of volume that has been traded horizontally in this range where I anchored this fixed range. So for us traders, it's extremely important to merge our technical analysis like supply and demand zones, previous highs and lows, but also look at volume analysis like fixed range tools. I know that many traders also like to look at indicators when it comes to technical analysis, and for this we can, for example, use a simple tool like the SMA. For the SMA, we have different lengths, and this one is looking at a 100 simple moving average. So we can see, even by popping in a simple indicator, we have had an amazing trade down here at around this 39,000 zone on Bitcoin. We've had a beautiful retest at around 59,000, and then we finally lost it and formed this range. So this is another great tool we can use. And for me, I would always like to merge or find confluences using different technical analysis tools. So let me have a look and give you an example for a trade I myself would be interested in. And that is looking at the Bitcoin chart. We can identify a previous supply zone. This is very easily being identified here because we've had supply come in once, twice, 3 times, 4 times, 5 times. And what did I say? Especially the supply and demand flips can offer great trades. And here we can see that this is lining up with the 100 SMA on Bitcoin as well. So another tool I could use, because I already explained that, is the fixed range. And I can see the previous fixed range value area high is also lining up with this zone. So that down here becomes a very interesting level of support on Bitcoin, which will be around $72,000. Now you can do that across every chart, use these simple technical analysis tools and find high probability setups and then plan on taking a trade if that level is hit. If you obviously want to learn more about these technical analysis tools, we have covered everything on the website. We have hundreds of videos covering every single technical analysis tool you can use to profit alongside us. But if you're looking for a simple insight into leveling up your trading career, in my opinion, this is the tools you want to focus on. You want to buy at support and you want to sell at resistance, and that is already, let me tell you, way ahead of the curve. So see you in the next videos. Most traders blow their accounts within weeks of starting out. Why? Because they skip the one thing that could have saved them, and that is demo trading. Today, I'm going to show you how to use software like TradingView and Orderflow without risking a single dollar and to practice like a pro. Stick around because this might be the difference between the 90% who lose and the 10% who win. Now, in this part of the beginner series, I'm going to give you an introduction to demo trading, and I will show you how to risk $0 of your own capital when starting to learn how to trade. So let's get into it. The key benefits are that it helps in learning mechanics of trading platforms and developing strategies without financial risk. Because sometimes people might even take losses by accidentally placing trades or placing the wrong order. So it does make sense to familiarize yourself with the trading platform that you're using, but it's always best to practice that with a demo trading account rather than using real money and losing money unnecessarily. So the key benefit here is that we have a risk-free learning. So what we can do is gain experience without the risk of losing money. We can also test strategies. So whenever I am testing a new strategy, I always prefer to do that on demo trading, because at the time I am testing a strategy, I don't know yet how well it will perform. So it's always best to not risk capital unless you have a proven system and you know the characteristics of each and every trading platform you are using. So one more thing, especially for the ones who are just starting out, which is extremely beneficial when it comes to demo trading, is the emotional control. We can practice managing emotions such as fear and greed in a simulated environment. In this lesson, I will also cover how to move from demo trading to real trading, as there will be differences and it will challenge you psychologically when you transition from demo trading to real trading and have actually money on the lines. The first thing I want to show you is here in TradingView and how to connect demo trading, how to apply demo trading in TradingView. So let's get into it. And for the paper trading account here on TradingView, we have access to a virtual account with adjustable balance. So first of all, let me show you how to connect your paper trading account to TradingView. So at the beginning, you will be in the main chart of TradingView. And down here, what you can see is the trading panel. So once you click trading panel, it allows you to open this window. And what you are simply going to do here is click on paper trading and connect your paper trading account. What you will see by default is that you have an account balance of 100,000. As you can see, there's no realized P&L, there's no unrealized P&L, as that is a new paper trading account. So for now, we want to close this window. But at some point we can refer back to it because we will see all the orders, the history and the account history, but also get a trading journal. That is very beneficial, especially if you want to journal your trades. So you don't have to actually write it down and collect all your trades. TradingView is going to do the job for you. So let's minimize this window and see how we can actually place a trade. For this, we're going to use a market that is currently open. I'm going to go down to a 1 minute time frame, just to see a little bit of action here. And I have to open my trade panel. It will open on the right side of your screen. And what you can do here is either do a limit order or a market order. So for this example, I want to do a market order. I want to use a 1 contract order. Okay, I'm also going to set a take profit. This will be, I think, for the sake of this example, I'm just going to take a quick short trade and I can actually just drag and drop it. So you have 2 options. One is to have a predefined take profit and a predefined stop loss. But what you can also do, what I will show you next, is simply take a trade. Here we want to do the sell order. This is not a real trade, by the way, just for the sake of example. All right, 1 contract is filled here and we can drag and drop the stop loss as well as take profit. So what's very convenient about TradingView is that it will actually show the dollar risk that we have in this particular trade, but also the expected reward. So this will be a risk of $325 for a potential reward of $650. Okay, so we can see currently this is an unrealized $160 profit. Let's move the stop loss lower so we actually get stopped out of this trade, so we can use this count journal here as well. So let's see, I'm just going to move it lower and lower because I want to be out of this trade to show you how it looks like once a trade is realized. Let me see. There we go. This trade is now stopped out. That's perfect. And we can go down to, this is not the way we would trade normally, obviously, but we can go down to the orders. And what we will see here is the sell order that we placed and the stop loss that we placed. We can also have a look at the history. That will be if the trade is filled, canceled. The take profit is obviously canceled. We can see a realized P&L of minus 175. The account history, this is where we see all the individual P&Ls. All right, this is minus $175. And in the trade journal, we will see everything that we've done by moving the stop loss, moving the take profit, and then eventually closing this trade. So that is a very handy tool here in TradingView to be able to trade every single market. We can do the same for Bitcoin, for example. We can simply connect the trading panel to paper trading and place a trade on Bitcoin as well. We might as well set a limit order. So why don't we set a limit order for a short trade up there, sell limit, and once Bitcoin hits 107,442, this account would enter a short trade on Bitcoin. We can again adjust the stop loss and the take profit to have that all calculated before we even take the trade. But since that's just an example, I can also delete these levels very easily. So besides paper trading or demo trading on TradingView, some of you are already using a order flow software. And for myself, this will be Atas. And Atas is a powerful platform for order flow analysis, and it offers a demo trading mode. So let's have a look at Atas and its demo trading mode as well. For this, I'm going to take you over to my Atas window here. This is my 1 minute scalping template for the Nasdaq. And what we have over here is also a demo trading account. Okay, so whenever you see under account that it says demo trading, you have a demo trading account selected. And when it comes to demo trading, it's very similar. It looks a little bit different here on the trading panel. For the ones that don't know how to open this, you can either use a shortcut, which will be the T on your keyboard. You can see I can open or I can close and reopen the chart trader, but I can also do it down here. Close it and open the chart trader. So what I can do now is take a trade, same as we did on TradingView. So let's actually buy the top here on Nasdaq. We don't like to do this in a real market environment, but just for the sake of this example, we can take a long trade up here and place a stop loss all the way down here and then aim for a nice move to the upside. Okay, we're trading at all-time highs on Nasdaq, but this is just the simulation for this demo trading feature here on ATAS. So whenever you connect your ATAS, there is the demo trading connected automatically. So you don't have to change anything. The only thing you have to do is open the chart trader and then you can start trading and start to learn how to trade. So besides market orders, we can also place limit orders on ATAS as well. So for that, we can close this market order. And what we are going to do is use the right click button on the mouse and then place a sell limit, for example. This is going to open a short trade once we hit that price level. Here we can see this limit order is executed and we can now set a stop loss and a predefined take profit, which will be the buy limit down here. So this is how simple and easy you can practice in a real market environment, as that is the same data one would get when trading with real money, but not having the risk of risking actual capital when someone is starting or learning how to trade. And as I said, even for the more experienced traders like myself, I would still make use of the demo trading when I test a new strategy and don't like to risk capital unless the strategy is proven that it's working. Okay, so this is always a great tool for the ones who are starting out. So as I said, demo trading always feels a little bit different compared to trading on a real account. On a real account, there is emotions involved. When it comes to demo trading, not so much, right? We don't really care if we lose paper trading money or make profits on that account. But when we're trading in a real environment and risk our own capital, there's emotions involved and we don't want to lose money, right? So the transition from demo trading to live trading should only be considered once you achieve consistent success in demo trading. So first and foremost, you want to have a strategy and a proven track record locked down on a demo trading account. What I would also recommend, no financial advice obviously, but is starting with a small live account. So start with a small account balance to ease the transition and manage emotional challenges. So for the ones who are testing on demo trading and then start trading with a very big account, that might even make the transition more difficult because these emotions will be a lot harder to deal with when there is a lot of risk involved. And what I would also recommend, as I previously said, is continued practice using a demo account to test new strategies. So whenever there's something you want to test or backtest, always refer back to the demo trading tool. And one important note is that demo trading does not replicate the emotional pressure when real money is involved. So be prepared for a different experience. And I can speak for myself that there will be a difference between demo trading and risking your own money. But that is something we can be prepared for and ease into slowly and gradually. We don't have to do it all at the same time and risk a lot of money. We can start with a small balance, take one trade on a real account, then transition over to a demo trading account to have a very slow and easy transition period. So in summary, the demo trading is an essential tool for beginners. I would recommend every single one to use. That allows you to build skills, develop strategies, and gain confidence without financial risk. So I hope you take that lesson very seriously, because we actually as traders have all the tools available to learn without risking capital. And let me know how it goes, and see you in the next lesson. Alright, if you're just starting out in trading, charts can feel super overwhelming. What do you even look for? Candlesticks, bars, or line charts? I remember when I started out, I was extremely confused. And let's not forget about time frames. There are so many different time frames. What should you even look for? Don't worry, I've got you. In this video, I'm breaking down everything step by step so you can chart with confidence. So let's get into it. Let's now have a look at what we as traders stare at the majority of the time, and that is price charts. So this will be an introduction to price charts. And then when we go over to TradingView, we can select many different price charts. So for this video, I want to focus on the most popular ones, which will be candlestick charts, which we're seeing here, line charts, as well as bar charts. So for price charts, it is important to understand why we actually look at this. And that is obviously because price charts visually represent market price movements over time. So on that note, it makes sense to discuss the different time frames. So on TradingView, we have the option to select different time frames for different market auctions we want to see. At the moment, it is selected to a 30-minute time frame. That means for every 30 minutes, we will get a new candle being printed. Now we can also set that to a different time. For example, if we decide to only look at the daily time frame, we will get one single candle printed every single day. For scalp traders, we can also go a little bit lower on the time frame and can even get a 1-minute candle being printed every single 1-minute auction. So this really comes down to your personal preference. If you're more of the low time frame trader or a higher time frame trader, you can select every time frame you like to use. So for me, I am always making my plans on the higher time frame, such as the daily, 4-hour and 30-minute time frame, and then drop down to the even lower time frame, such as the 5-minute and 1-minute, to make an informed decision. Let's start with the most simple price chart we can look at, and that is the line chart. So there's a very big difference between a line chart and a candlestick chart, and that is that we only have very limited data available if we look at line charts. So as opposed to looking at candlesticks where we get the open, high, low, and close of a candle, using a line chart, we will get every 30-minute auction, because we have selected the 30-minute time frame. We get the closing prices connected to one and another, and we will get a simple trend. What we lack in this line chart is the detailed information of the opening, high, and low in each and every 30-minute auction. So this time frame or this line chart can be useful if a trader is looking for the high time frame trend and looks for a simplicity in price charts and only wants to see the overall trend. For me as a scalp trader, I don't really like to look at line charts too much. Sometimes I refer back to it for the overall trend, but it is lacking detailed information, so I prefer to use the candlestick charts, which we can look at next. A candlestick chart represents much more detailed information compared to a line chart. So if we have a look at this on the daily time frame, so for every day we will get a new candlestick being printed. We can have a look at the characteristics of a candlestick. And here we can see 4 very important data points. We get the open. This will be down here. If we choose to look at this daily candle, we will get the open of the candle, we will get the low of the candle, the high of the candle, as well as the close of the candle. So the typical color coding is that for a candle that moved up in price, we will get a green and thus bullish candle. Now that means that the closing price is higher than the opening price. So as a reminder or something you can note down, if price is closing below its opening price, we will have a bullish candle. And vice versa if we have a bearish and red candle. So for a red candle, we can see the opening of that candle, we can see the high of that candle, we can see the low of that candle, and the close of this candle. And it will be a bearish candle if the closing price is lower than the opening price. Candlesticks are especially popular for short-term traders who want to see as many detailed information as possible for a 35-minute or 1-minute auction. It is also very useful for the higher time frames, but especially for low time frame trends, we need to see as much information within a single candle as we can. For me as a scalp trader, this is the chart that I primarily use. So for all my analysis I am doing, I refer to candlestick charts. So it doesn't matter if it's the higher time frame or lower time frame, I prefer to look at this detailed information of price charts. Now next we can have a look at bar charts. So this will be this right here. And this already looks very different. So let's zoom in on a daily time frame. That's probably best. And we can have a look at this particular example and I will explain what bar charts do. So for bar charts, we also get the open, high, low and close price, but in a more compact format than candlesticks. So what we will see here, if we look at this particular candle, we will see the open, which is this horizontal line to the left. Then we will get the low of this bar, we will get the high of this bar, and the close of this bar, which will be the horizontal line to the right. From the low of this candle to the high of this candle, this is visually shown by this vertical line. And same as with candlesticks, if we get a close that is above the opening price, it will lead to a bullish candle, and vice versa. If we get a closing price that is lower than the opening price, we will get a bearish candle. Bar charts are preferred by some traders as it's a clear representation of price ranges within each period. And that is offering balance between simplicity and detail. For bar charts, we have less visually intuitive than candlesticks, but it provides the same essential information. For me, however, I like to look at candlestick charts because for me that is much more obvious. For you as a trader, it's extremely important to choose the right price chart that fits your trading style. And the line charts can be best for long-term trend analysis and simplicity, as I already discussed. For candlestick charts, it is ideal for short-term trading and pattern recognition. For example, we can look at doji candles or engulfing patterns. Bar charts, it's useful for traders who prefer a clear, concise view of price ranges and movements. But this comes down to a personal preference, so the choice of chart type often depends on the trader's style, goals, and the level of detail they want to have. Combining chart types is also something we as traders can do. As I said, when I sometimes want to have a simple high time frame trend, I can always refer back to the line chart. So just because you are using the candlestick chart most of the time doesn't mean that you can't at times refer back to a different price chart. And in conclusion, price charts are an essential tool for traders, each offering unique advantages depending on the level of detail and analysis required. So I hope you could learn something in this lesson, and I hope you can make a decision on which price chart suits you and your trading style best. Do you know the #1 reason why traders blow their accounts? It's actually not trading the wrong setups. It is having the wrong strategy for the market environment. There is a critical difference between trading in a trending and in a ranging environment, so your trading strategy has to be adjusted accordingly. If you're trading the wrong strategy in a trending market, you can run into avoidable losses. So in this video, I'm going to show you how I am identifying a ranging or a trending market and how I am adjusting my strategies. So let's have a look. Let's now get into the charts and have a look at the difference between a trending and ranging environment, how to spot it, and how to adjust the trading strategy accordingly. When it comes to trending and ranging environments, for us traders, it's extremely important to always be aware of the high time frame but also low time frame trend. We have to adjust our strategies and also need to know if we are in a trending or ranging environment to make an informed decision about our risk management. Markets can be broadly classified into two types. Trending means moving in a clear direction, and ranging means moving sideways without a clear direction. The purpose is recognizing the type of market you are in, because it's crucial for the right trading strategy. It can impact our trading decisions, so different market conditions require different approaches. What works in a trending market may fail in a ranging one. That is already a key learning for you. The trading strategy that is working in a trending environment might fail in a ranging environment and has to be adjusted accordingly. But I will obviously cover that. So let's first have a look at a trending market. What actually is a trending market? So a trending market occurs when price is consistently moving in one direction, either upwards, which is classified as an uptrend, or downwards. So the characteristics of an uptrend is higher highs and higher lows for an uptrend. So prices is forming higher highs and higher lows. A downtrend is characterized by lower highs and lower lows. So that means in a downtrend, price forms lower highs and lower lows over a period of time. So let's have a look at this and actually mark out a uptrend for Bitcoin. So what we can clearly see is that Bitcoin is in an uptrend, so we can see prices going up. But how do we actually select the pivots for us to decide if this is a valid uptrend? So first and foremost, we need a low. This is the low down here at around 16,000. Then we can see prices making a higher high in relation to this previous significant high that we've had here. Followed by that, price formed a higher low. So in relation to this previous overall low, price is clearly making a higher low. Next, we can see that price is forming a higher high. So this is already a confirmed uptrend because we have the three pivots that we need. Let me pause here and mark it out. So the first pivot we need is the higher high. Okay, so this can be classified as number one. Pivot number two we need for a trend to establish is a higher low in the event of an uptrend. This is given down here. And upon the break of this previous higher high, we get a confirmed market structure change. This is right here because we can see that previous higher high is breached again. So at this point, this can be classified as a valid uptrend and a confirmed market structure change to the upside. So let me hide a couple of levels and continue this uptrend on Bitcoin. So I want to use that tool again and continue where we left off. So here we can see price again is forming a higher low. This is followed by a higher high. And then we can see one very interesting thing down here. So what we see is price is technically forming a lower low. Why can that still be classified as an uptrend? And the reason for this, which is something you want to note down, is that we have only seen a liquidity grab. So what we can see is price wicks into the level, but we don't get any candle closes below the previous low. So for me, that means we have technically not changed the market structure and rather taken the liquidity below a significant point to drive another move to the upside. So as a reminder or as something to note down, if a liquidity is only taken below a previous low or high and candles are not closing below, I am not classifying this as a market structure change. So let's continue with this trend. After that, we can see price again is forming a higher high. This is followed by another higher low. Price is forming another higher high, higher low, and another higher high. So this is a very perfect uptrend on Bitcoin. We can clearly see how price is forming higher highs and higher lows. So when it comes to choosing the right trading strategy, we obviously have to go with the trend. So why would it make sense to try and fade this move, look for short trades and aim for new lows when we see that the market is simply forming higher highs and higher lows? So let me show you what I mean by that. Let's say, for example, up here we are looking at a key resistance and want to take a short trade. The aim for this short trade is to make a new low. Now for us traders, we have to analyze market structure and say, is it really likely to form a new low if we're seeing a clearly bullish market structure and price is making higher highs and higher lows, and thus we have a lower probability to actually take these lows. So for us traders, we have to adjust the trading approach, and that means we have to take profits a little bit quicker. So when I am counter trading a trend, I always need a quick take profit one, and upon hitting take profit one, I want to move stop loss to break even. Now, on the opposite side of things, when I'm going with the trend, so let's, for example, I'm looking for a long trade down here because I identified key support down here. I can aim for a new high to be made because I am going with market structure. Okay, so at this point, I am less inclined in taking a quick take profit one and rather more interested in letting a trade run. And even after hitting take profit one, I don't necessarily have to move my stop loss to break even. I can obviously do that, but I don't have to. And I typically leave a larger position of this trade open for a scenario that we simply get continuation of a trend. And I obviously want to be exposed to this nice uptrend, and I don't want to fold this entire trade too early because I want to still profit on this uptrend. Now, as a trader, I'm obviously capable of identifying these trend changes, and once a trend changes, I can start thinking about reducing my position again and de-risk my position. So whenever I go with the trend, I am more conservative with the take profit one and leave a larger chunk of my trade open. So we have to keep in mind that we do have trends within trends. So here we're looking at a high time frame trend. But for day traders or scalp traders, they might identify a low time frame trend that is within the bigger trend. So for the day and scalp traders, although we can still take short trades within a higher time frame uptrend, we always have to be aware of the higher time frame trend and keep that in the back of our head. So whenever I am planning a day trade or even a scalp trade, I always know what the higher time frame trend is looking like, and I always factor that into my trading decision. Besides that, once a clear trend is identified, for us traders, it's obviously best to go with the trend rather than chasing it and look for longs on pullbacks. In a ranging environment, it doesn't make too much sense to long every pullback or short every rise. Whereas if we are trading in a clear trend, we should wait for pullbacks to fill our long trades. And in a downtrend, if we look at this, for example, where price is clearly forming lower lows, lower highs, lower low, lower high, lower lows, so this is classified as a downtrend, we should short the rises. So let's now have a look at the difference and have a look at a ranging environment. So for this, I want to choose an example on Ethereum, and let's clarify what a ranging environment is. So a ranging market occurs when price is moving sideways within a defined range. That means bouncing between support and resistance levels. So let's have a look at this on Ethereum. Well, we can clearly see that price is rejecting a resistance level and price is clearly bouncing off support down here. We cannot identify a clear trend and rather view this as a consolidation or ranging market. So here we can clearly see that price is fluctuating within a horizontal range without establishing a clear trend. The market is confined by support levels, which is the bottom, and resistance levels, which is the top. So let's have a look at how we would have to adjust a trading strategy if we are trading in a trend. So say, for example, I am looking for a long trade down here. I have identified a support level down here, and I also identified that price is trading within a range. So in a market or in a ranging environment, I would obviously aim for a new high because I'm going with the trend and I'm expecting this trend to continue. Whereas in a ranging environment, it does not make sense to aim for a new high because we can see price is kept within the range. So the probability of taking the highs at this point is pretty low. So for me as a trader in a range, I have to look for take profits that are inside the well-defined support and resistance areas. I'm not aiming for a move above a high and rather look at something in between where I'm taking profits. For me, this means taking a larger take profit than trading with the trend. When I'm trading in a range, I'm typically taking 75% take profit 1. So that means on the first take profit, I'm I'm taking off the majority of my trade just for a scenario that this range is continuing even longer. So I'm always keeping 25% open because as we have seen here, at some point a range is going to break. I myself am not a breakout trader, so I would never trade the break of a range. But if I'm already in a long trade from the lows, I want to be exposed for if we get a nice move above the range high. So when it comes to trading a range, what I typically do is long the range low and short the range high. So this means in a trending environment, I am less interested in taking short trades and I am more interested in longs on pullbacks, which makes sense, right? But when it comes to trading a range, I'm open to trading both sides of the market. So whenever we see a move into the range lows, I'm looking for long trades. And if we start to see moves into the range high, I'm looking for short trades. And thus I'm positioning myself with both or in both sides of the markets. And there's one golden nugget I can share with you, and that is, if you manage to get into a long trade at the range lows, I would never close this long trade even when I'm taking a short trade at the range high. So this allows me to be exposed to the market wherever it is going to break. So here, for example, say I have taken the long trade on Ethereum at the range lows, and I'm also in the short trade on Ethereum from the range high. So at this point, for me as a trader, wherever this market is heading to next, I am making money. If I get stopped out of the rest of this short trade, so I would obviously take profit 1 down here, but if I get stopped out of the remainder of this short trade, I still have my long trade and I would simply stay in the long trade and keep that going. So this is something you definitely want to mark, or that is something you want to note down, because this is how we as professional traders can trade a range and profit from whatever is going to happen next. And that is the best thing you can do as a trader, to make profits no matter what happens next. So we don't have to anticipate, we don't have to predict what's happening next. Either way, we're making money, and that is our goal as traders. So there is a difference between trending and ranging environments. We have already identified that here. And this has significant impacts on your trading decision. So when we're trading with the trend, just to summarize, we want to use strategies like trend following or to enter trades in the direction of the trend. So if we are in an uptrend, we likely don't want to take too many short trades. What we want to avoid as well is counter trading. Whenever we identify a trend, it's always best to go with the trend rather than fading it. In a ranging market strategy, we buy near support and sell near resistance, as we've seen with this example. What we want to avoid is breakout assumptions. So if we have a look at this once more, we do not want to trade breakouts because sometimes what we see is simple liquidity grabs. So let's have a look at this example up here. Let's clean this up a little bit. Some people might have looked at this and say, wow, we have broken the range high. We will now see continuation to the upside. But that might end in a simple liquidity grab for another rotation within this range. So I don't like to trade breakouts. If we do get a retest of a range, that is an acceptable trade. So this would look something along the lines of this: spend time and value above, then get the retest, then I can look for a long trade here. But just with the break of a range, I would never take a long trade. That is very bad in terms of the stop loss placement as well, because this would be quite a large stop loss. So that is something I avoid doing, and I avoid making assumptions if a range is going to break or not. And what we should also take into consideration is the risk management. So we should tailor our risk management strategies to the market type. So we should use a tighter stop in a ranging market, and we can be more flexible in trending markets if we are going with the trend, obviously. So let's conclude with what we have learned in this lesson. Identifying whether a market is trending or ranging is crucial for choosing the right trading strategy. Adapting your approach to market conditions can improve your trading success significantly. Once again, we have to be aware of a trend whenever we are taking a trade on the higher or lower time frames. So I hope you learned something in this video, and I hope I was able to help you avoid taking unnecessary losses. It is actually not as difficult as it seems like if we are able to spot these trends and adjust our trading strategy accordingly. I want to help you become a professional trader starting from a beginner's perspective. So if you want to learn more, stick with this beginner series. We will be releasing 2 videos each week, so don't forget to like and subscribe and follow along. So see you next time. If you're new to trading, understanding order types is essential. In today's video, I'm going to explain you all the important order types you need to know, from market orders to limit orders, and also what is a stop loss, what is a take profit. So by the end of this video, you have seen some real-world examples and you know how to use order types to your advantage. So let's dive into it. So welcome back to the charts, and now let's have a look at some different order types, because for us traders to actually be exposed to the markets, we obviously have to take a trade, and for that we need to know which order type to use for what specific trade. What are order types and why are they important? So an order type is an instruction given by you as a trader to your broker on how to execute a trade. And the purpose is that different order types allow traders to control their entry and exit points, manage risk, which is very important, and execute their strategies efficiently. So the first order type I want to have a look at is a market order. So a market order allows for immediate execution at current price. The definition of a market order is that a market order is an instruction to buy or sell immediately at the best available current price. So let's have a look at this. And for this, I want to use a BTC. Because we don't have too much volatility for now, I want to go down to the lower time frame so we can actually see what's going on down here. And in this example, I'm going to use a simple paper trading account on TradingView. Okay, so for a market order, what you want to do on TradingView is look at this field right here. So currently, or that is what it's automatically set at, is always a limit order, but we want to use a market order. So you click on market. The next thing you can do is select the units you want to trade. So for this example, let's just use 2 units. So this will be 2 contracts of BTC. Right, so now we want to predefine a stop loss that will be below this low right here. So I'm going to use 97,440 as my stop loss. 97,440, I can type it in here. It's going to show me the predefined risk of this trade, which will be 437. And I also want to use a take profit. That is going to be 98,000. This is just an example. So we can see the execution of a market order. And what a market order should do is give me the instant order execution at this price. So you will always see the current price at your right vertical value field here. Okay, so I'm going to place an order here and you can see instant execution, right? So that is the benefit of using market orders, because we can get the current traded price with an instant execution. The use case for this is that it's ideal for traders who prioritize getting into or out of a position quickly, especially in fast-moving markets. And this is very important for scalp traders, for example. So I myself identify myself as a scalp/day trader. And for me, when I'm scalp trading, so trading on the very low time frames, I need to ensure a very fast execution of my orders. And for that, I'm always using market orders. Now, when it gets a little bit more complicated, there's things we have to take into consideration as well, and that is the fees. So when we're trading Bitcoin, the fees on market orders are significantly higher as opposed to the fees on futures. So while on futures, I don't really have to care about the fees of market orders too much, I do have to keep that in mind for Bitcoin and also think about a different order type, which is limit orders. So that's what I'm going to cover next. So for this trade, that was just an example. I'm just going to close this trade because here I just wanted to show you the execution of a market order. So I'm going to close this, and this, by the way, if I close a position, this is also via market. Okay, so here this position is now closed, and let's have a look at the next order type, which is limit orders. So for limit orders, we can control our entry and exit prices. A limit order is an instruction to buy or sell at a specific price or better. So that means I can already identify a level of interest, which, for example, can be the $98,000 zone on Bitcoin, sitting above all these highs, and I can place a limit order that if price reaches this level, it is going to fill a trade. So that means I'm not executing where we are now, and instead wait for a predefined level to be hit and then automatically place a trade. So for this, I don't even have to be in front of my computer. Once the limit order is set, it is going to execute my trade no matter what, unless I cancel the order, obviously. So the order will only execute at the specified price or a more favorable price. It won't execute if the market doesn't reach the limit price. So that means if I place a limit order, which I'm going to do now, so here from market order, I now have to set it to limit order. And what I want to do is look for a short trade, so a sell order around 98,000. So I can type in 98,000. And for this, I only want to place a stop loss. So let's just say, this is just an example, right? So I would not place this trade right here, so it's not an actual trade, just to show the execution. Let's use 98,200 as the stop loss, so that will give me a $400 risk, and I can now set this limit order. So this limit order is only going to be executed if price increases and hits the 98,000. So once that level is hit, it is going to execute the sell limit, and it is automatically placing my market stop loss. So if price just breaks through 98,000 and hits 98,200, my limit sell order here is going to be cancelled and stopped out at 98,200. So this can be particularly helpful if a trader is not actively in front of the PC and wants to place trades at predefined high levels of confluence. So for me personally, I would only preset levels via limit if I have a very strong statistic or a very strong confluence at a specific level and allow myself to enter a trade without waiting for the reaction. So unlike with market orders, a limit order does not allow you to wait for a reaction at the level and instead enters the trade whenever your predefined level is hit. The use case is that it's useful for traders who want to ensure they enter or exit a trade at a specific price level. What you want to note is that limit orders may not be filled if the price never reaches the desired level. So that is what I wanted to say here. If price is just dropping to the downside and never reaches that $98,000 zone, you won't get filled on this trade. And that means if you are very confident that price is dropping from here, a market order might be the better choice, because then you are definitely going to be exposed to the markets, while with a limit order you might be left behind. So now there's one more thing I can show you, and that is how to combine both entry types, which is specifically interesting for trading Bitcoin. So here what we want to do is place a market buy. So this is going to be a simple long trade down here. I can set my stop loss just for the sake of this example. But on BTC, what I would normally do on Bybit is to set a take profit via limit order. And that is for the reason that limit orders have a lower fee as opposed to entering on market. So for example, if I want to close this trade at 98,000, I can also set a limit sell at 98,000. So this will then this is going to be a take profit order, but instead of using a market order, this is going to be a limit order. Okay, so this is a little bit of a trick on how to save some fees on Bybit. All right, so you want to market, no financial advice, but you want to market on, or you want to enter a trade on market, and you want to close a trade on limit orders. So that's that example. And now let's also cover a stop loss order. So a stop loss order is protecting against adverse price movements. So that means down here, I am expecting for price to rise, hypothetically speaking. So it's not an actual trade, but just for the sake of example, if I'm taking a long trade, I would obviously expect price to rise. So a stop loss order is going to protect me for a scenario where that is not happening. So if price keeps dropping to the downside, I can predefine a level where I want to be out of the trade and limit my loss, because nothing is limiting price without a stop loss to just keep dropping to the downside, and my loss of a specific trade can be infinitely large, right? So that is why we always place a stop loss. A stop loss order automatically sells a position when the price reaches a predetermined level, limiting potential losses and vice versa. So this is what I'm doing down here. Before I enter a trade, I know where my stop loss is going to be, and I know how much I am going to risk in that specific position. So the order converts to a market order once the stop price is hit, selling the asset at the best price available. So that means a stop order is a market order, ensuring me to be filled once that price is hit. Okay, so once 97,409.5 is hit in this specific example, this is going to convert to a market order and instantly closing my trade. The use case is that obviously this is essential for risk management. Stop loss orders help prevent large losses in volatile markets, and I myself use a stop loss for every single trade I'm taking. In highly volatile markets, the actual price may differ from the stop loss level. This is called slippage, or this can also happen when trading on a very large account. So it always comes down to the liquidity at a specific level to see if we can get filled at that exact price. Now that doesn't matter too much for trading futures, because on futures there's literally zero slippage. But on Bitcoin, that is something we might want to consider as well. So it does make sense to always allow a little bit of room for a stop loss for a scenario that it's not going to be the exact predefined level. And this shouldn't lead to any larger losses. All right. So let's also have a look at take profit orders. And for this, I want to cancel this order right here to then have a look at a limit or a predefined take profit level. So a take profit order automatically closes a position when the price reaches a predetermined profit level. So let's have a look at this. We are now in a trade on BTC. We can reduce the risk a little bit more to keep risk management in mind and the risk to reward, which is going to be its own separate lesson. And here I want to take profits if we make a new local high. So here we can see my take profit is set above this local high at 97,760. So once price reaches that level, it's going to take my position or take the take profit of $405 and close the position. This is going to cancel all orders. So the stop loss order is going to disappear. My long trade here is going to disappear. This order is going to be filled. So my trade is simply closed for $405 profit once that level is hit. The order triggers a market or limit order once the target price is reached, ensuring the trader locks the trade. So, the use case obviously is to secure profits by selling a position at a specific price level. And why is it so crucial to have a predefined take profit? So we need to know where we want to get out of the trade and where to place a stop loss. Because what we can see here, and this is very, very crucial information, which I'm going to cover as mentioned in its own separate lesson. But here we're risking about $200 on this trade. So if the stop loss is hit, I'm going to lose $200 on this trade. But if my take profit is hit, I am going to win $400 on this trade. So that means my potential or expected reward is twice as big as my risk. So from a risk to reward standpoint, I can say this is a trade worth taking because I have double the amount of profits I can make as opposed to the risk I'm taking on this trade. And a take profit and stop loss order helps you to visualize this. So, similar to limit orders, the trade may not be executed if the price doesn't reach the take profit level. So say price is lingering here for a little bit and then we are dropping. I might still be stopped out of this trade unless 97,760 is hit. And let's now have a look at some other order types. And one of them is a stop limit order. This is a combination of a stop and limit orders where the order becomes a limit order once the stop price is triggered. We can also have a look at a trailing stop order. So this is a dynamic stop loss that moves with the price, locking in profits while protecting against losses. This is something we can do on advanced trading software like Autoflow. This is also going to be its own lesson I will teach. So when we look at Autoflow, we can have trailing stop loss, and that means we can preset after what increments of price the stop loss is following the price. So let's say, for example, I am already a nice profit, so $150 profit. I'm happy with that. And now I want to move my stop or trail my stop loss. That means whenever price is moving to the upside, my stop loss is simply going to follow. Here on TradingView, I have to do it manually, but on advanced Autoflow software, I can do that automatically. So we can see price is now moving to the upside again, and what a trailing stop loss would do is just follow price to the upside. We can, for example, give it $50 difference, and every $50 move to the upside, my trailing stop loss is going to move higher as well. Okay, so this is what a trailing stop loss can do, and that allows you to box in price. So as opposed to having a predefined take profit, a trailing stop loss can just follow price however far it wants to go. That is how I am using trailing stop losses. Sometimes when I do foresee a lot of potential for more upside, I'm just going to let my stop order continue just follow price and continue higher and higher as opposed to closing a trade at a predefined level. So this is now covering the most important order types that I am using on a day-to-day basis. There are obviously many more. Please let me know in the comments below if you want to also learn about good till cancel orders, bracket orders, day orders, because there is a few more. But here I wanted to focus on the most important ones that can actually help you get exposure in the markets as well. And we don't want to overcomplicate it for this beginner series. Choosing the right order type is very crucial because understanding when to use each order type is crucial for optimizing entry, exit, and risk management. And also keep in mind what I talked about with the fees. So once you know these insights that a limit order is cheaper than a market order, you can already have an advantage to other traders who simply are using market orders for each and every entry or exit point. So for risk management, stop loss and trailing stop loss orders help limit potential losses. And also, this is also something you want to note down, if you don't have a predefined target for the trade and you foresee a lot of potential, I said you can use a trailing stop loss because that is a method of boxing in price and allowing for just continuation of price to rise to the upside. This can help with profit maximization. If price has more potential to the upside, you might not want to close at a predefined level. One different thing to keep in mind is the execution speed versus price control. So market orders prioritize speed because you will get instant exposure to the markets, while limit orders prioritize control. So you are in control where your order is going to be filled. And to conclude and give a quick summary, different order types give traders the flexibility to control their trades, manage risk, and execute their strategies efficiently. So I hope you could learn something in this video and now understand how to use different order types according to your specific strategy. Stick around because I'll be delivering more beginner videos to you so you can fast track your trading journey and learn alongside us. So see you in the next video. Most beginner traders focus on trying to predict the market, guessing on when to buy or when to sell. But here's the truth. If you don't understand your risk to reward ratio, nothing else matters. It's not just important, it's the foundation of everything in trading. So stick around because in this video I'm going to explain to you step by step what risk to reward means, how to use it, and how to adapt your strategies. So most of you have probably heard the term risk to reward ratio before, but let's actually see if you understand what exactly is meant by risk to reward. So the risk to reward ratio measures the potential reward of every unit of risk taken in a trade. The purpose is that it helps traders evaluate whether a trade is worth to be taken or not. So I'm going to show you a real example here on Nasdaq measuring the risk to reward. So let's just assume we want to take a long trade here on the Nasdaq. I'm going to use the risk to reward tool here in TradingView, which is going to measure the risk to reward automatically, but nevertheless we have to clarify what is actually meant by that. So what we can see, if we were to take a trade here on the Nasdaq, this is giving us a 1.84 risk to reward ratio with a stop loss below this low and a target. Let's actually use the all-time high on NQ. This is going to adjust the risk to reward ratio with a 2.7. So that means our potential reward of this trade is 2.7 times the amount of risk we are taking in this trade. Okay, so whenever we have a risk to reward above a 2-to-1 ratio, it means that a trade is worth to be taken. Let's have a look at this here on Nasdaq. Our risk is whenever price is in this zone down here, this would mean our position is in the loss. Before we take a trade, we want to know exactly how much we can potentially lose in this trade. Okay, so let's just assume we take it on a 1 contract position size. And then we can see how many ticks is this stop loss away. And what we can see here is that this is 400 ticks away. On Nasdaq, for every tick, we risk $5. So that means we have to calculate 400 times 5. And in this example, this is going to be a risk of $2,000. So let's just see, or let's write it down here, and then let's see what the potential reward is going to be on that trade. So the risk is going to be $2,000. So for it to be a 2-to-1 risk to reward ratio, we at least want to make $4,000 profit. So risking 2,000 to potentially making 4,000, this is a trade that is worth to be taken. And in this particular example, we can measure the tick size of our target. And for this instance, let's just say it's around 1,000 ticks. So for this example, we have an expected potential reward of $5,000. So that means we are risking $2,000 to potentially make $5,000. Now I'm going to show you why it is very important to be aware of the risk to reward ratio and set it in relation to your win rate. So even with a lower win rate, a good risk to reward ratio can lead to profitability. For this, I want to show you a graphic. So what we can see here is that with a 1-to-1 risk to reward ratio, that means if we risk $100, we expect to make $100 in this trade. We need to have a 50% win rate to even be break even. So we need a 60% win rate to be profitable. If we, however, have a 2-to-1 risk to reward ratio, so if we risk 100, we at least expect to make $200 on this trade, we only need a 40% win rate to be profitable with this strategy. And what we can see here is that if we go down the list here and we actually use a 4-to-1 risk to reward ratio, that means that even with a small win rate, like a 30% win rate, we can achieve profitability when focusing on the risk to reward. So dependent on your strategy, if you are aiming for a higher win rate or a higher risk to reward, you have to adjust your expectations of a trade. And using a consistent risk to reward ratio helps to maintain steady performance. So for me, for example, I am always at least aiming for a 2-to-1 risk to reward ratio because I have identified that for my strategy and the strategy I am using, I have a fairly high win rate. So a 2-to-1 risk to reward ratio is what I should at least be aiming for, preferably even more. So now let's also have a look into how to incorporate risk management strategies into this risk to reward tool. So before we take a trade, we should agree with ourselves on a specific amount of money we can allow ourselves to lose in every single trade. So for me, that is 1 to 2% risk of my entire portfolio per trade. So when I am risking a trade, I am never risking more than 1 to 2% of my portfolio. Okay, so let's just say this is the maximum potential that a trader identified for his trade. If the stop loss is still down here, there is some things and tweaks around it how you can achieve a better risk to reward by having the same target. Because we can clearly see prices forming lower highs, so we should, for a trade, not necessarily aim for a new high. So what we can do is also adjust the stop loss, and what we can see here that this is increasing the risk to reward to a 3.1 risk to reward. So that means if we are, for example, risking 100 on this trade, we are at least aiming to make 300 on this trade. Now, one thing we have to keep in mind is that we should not keep the stop loss too tight, okay, just to try and achieve the best risk to reward ratio, because this, for example, is giving us a 70.7 risk to reward ratio, but there is a very high probability to be stopped out of a trade like this. So we should always keep a realistic stop loss as well as a realistic take profit and target for the trade. So let's now summarize. For a trader to ensure a profitable system over the long term, it is essential to understand risk to reward and align the risk management with this risk to reward tool. You have seen that even with a low win rate, A trader can achieve profitability if there is a good risk to reward with his system. So I hope you now understand how crucial risk to reward ratio is, and I hope that you can now avoid the common pitfalls many traders do. You are now ahead of the journey, so stick around because I'll be delivering 2 beginner videos every week. So see you in the next one to elevate your trading journey. Goodbye. Imagine this, you're in a trade, the market starts moving fast and suddenly you're panicking. Should you buy more? Should you sell? Or should you hold on to your trade? That's probably because you didn't have a trading plan. In this video, I'm going to explain you what a trading plan is, how to use it, and how essential for each and every trader it is to have and follow a trading plan to stay ahead of the curve. So what is a trading plan and why is it so important? A trading plan is a structured approach that outlines how a trader will identify opportunities, manage risk, and execute trades. The purpose is that it serves as a roadmap and it helps the traders stay disciplined, avoid emotional decisions, and stay consistent. So it is very important because a trading plan increases the chances of long-term success and minimizes the risk of impulsive, unplanned trades. So whenever we take a trade, we want to pre-plan what this trade is going to look like and what we are risking on that specific trade. Let's have a look at the key components of a trading plan. So what are we actually looking for a trading plan? And there is some things that are more towards the high time frame or towards the long term of a trading plan, and also the intraday levels we're looking at for each and every trading day. So the first one is that we should define trading goals. This can be daily, monthly, weekly, or also yearly trading goals. So how much annual growth or how much monthly growth do we want to achieve with our trading activities? Besides that, we should have a risk management that is outlined so we know exactly how much we are risking for each trade. And also maybe there's going to be a risk limit per day. So say, for example, you're taking 3 losses in your daily trading plan, you can identify that after losing 3 days in a row, you stop trading for the day. Besides that, we want to do market analysis and include market analysis into our daily plans. So we define the assets we are trading on that day. This might be crypto, futures, stocks, maybe a mix of both. And we should include that in the daily plans because we should only trade the assets that we are prepared to trade and where we have done the daily plans in advance. Besides that, we should identify trade criteria. We should define an entry and exit criteria based on technical analysis and developed strategies. Before we take a trade, we should always know how we are entering that trade if it comes into play. One thing that I particularly like is establishing a trading routine. This can be a daily routine, like what habits do we want to include before we start trading? For me personally, that is doing a meditation before I jump into the trading day. We should also include pre-market analysis and post-trade review. As I've explained in previous videos, we should have a trading journal. So when we do a daily plan in the morning, we should review that at the end of the day and see how well that trading plan played out. Record keeping is very important. That not only tracks the daily performance, but also the monthly and yearly performance to identify mistakes and areas of improvement. So what I want to show next is one of my daily plans that I post every day within my trading channel at Chart Champions. So here, for example, it's a daily plan for ES. ES daily plan, I'm looking at the daily open. I will always check if the daily open is inside the previous day value area or not. And don't worry, this is something I'm covering within our Chart Champions course more in depth. Then I'm analyzing the context and I'm identifying the longs of interest as well as shorts of interest. I'm always attaching a screenshot so I know exactly where my areas of interest lay for that day. This is how a typical daily plan looks like, which I am doing every single day, because I am only taking trades that have a high probability to play out. And with that being said, those are trades that I have pre-planned in the morning. One thing you have to keep in mind when it comes to daily plans is the over-optimization. So constantly changing a daily plan can lead to short-term bad results. So what we want to do after forming a daily plan is being open to adapting if the market context changes. But if we have a plan, we should follow this plan and not try and form 100 daily plans on the day. Okay, there's one plan, we follow that plan. If it's invalidated, we move on to the next trade. To summarize, a well-crafted trading plan is essential for success in trading. It provides structure, discipline, and it is a roadmap for achieving long-term success and profitability in trading. So I hope you could learn something in this video and now understand the importance of 1, having, and also B, following a trading plan every single day when we are participating in the markets. So I'm going to deliver these videos twice a week, so make sure to hit the follow button, like this video, stick around, and see you in the next videos. Goodbye. Have you ever wondered why the market moves the way it does? It's not just about price action, it's also about volume. Imagine being able to spot when large players are entering the markets and also being able to identify when a trend is losing steam. In this video, I'll introduce you to the volume analysis, one of the key parts of every successful trader's analysis. So stick around because you'll learn a lot in this video. Let's now look at volume and see how we can identify where the large traders are participating in the markets. For volume analysis, first of all, it's important to understand what volume analysis actually is and what it's trying to do. So volume represents the total number of shares or contracts or units traded during a given period. So for example, with volume analysis, we can find out how much volume was being traded in this entire range on Bitcoin, for example. Typically, it is measured showing a histogram on a price chart, and this is indicating the level of activity in the market. I'm going to show you a simple tool on how to do that. For this, I'm using the fixed range volume profile indicator on TradingView. So we can now, after identifying a well-defined range, anchor this fixed range and see or analyze this entire volume inside this range. So now what you will see is 3 lines, but what do they actually mean? So the red line is the point of control. That is the most amount of volume being transacted within this range. So the most amount of volume was traded at around 97,200. So this is the vertical histogram box that is showing the high volume nodes within this range. Now these orange lines are the value area high and value area low. So that means within this range, 70% of this entire volume was traded within this box. Okay, the value area low is the lowest point, including the 70%. The point of control, the red line, is where the most amount of volume was transacted. And the value area high is the upper extreme, including 70% of this entire volume. So what we can do by using volume analysis is spot if a move to the upside is sustainable or not. So what we can see is that not many traders were participating on this break to the upside, where we've actually made the current all-time high on Bitcoin. Now, why is that? Because we can clearly see this is not including 70% of the volume being transacted in this range. So that means upon breaking this level or breaking into all-time highs, volume was not following the move and the majority of the volume still was traded down here. So there's one more tool we can use, which is the volume indicator. Let's now have a look at another example. So here, for example, we are once again trying to break out of the 70% range, so the value area high of our volume being transacted in this range. We can see prices moving to the upside, but what we can see here by simply looking at the volume bars is that volume is clearly dropping. So on this move to the upside, the volume was decreasing, and that is typically not referring to a strong break to the upside. What we want to see for trend continuation is 1, the market moving to the upside, but also volume following the move. This is, for example, what we have seen on this drop on Bitcoin. We've seen a move to the downside and the volume was fairly large up here. It was not increasing on the way down, but it was above average. So this white line, which you can see here, is the average volume. This is a very helpful indicator to spot irregularities. So here we can see there was a lot of selling going on in this price action in this section of the chart. So now let's cover why you should integrate volume analysis into your trading. And this is because with volume analysis, we can confirm trends. As I've shown you in this example, it's very easy to spot if there's a high probability for a trend to the upside to have follow through or not. And one thing I must say here is that this is only touching on the introduction to volume analysis. So we have extended courses on this entire volume analysis because that is a very complex topic, but this is the things that you should definitely understand when starting out your trading journey. Besides that, we can identify reversals. So a spike in volume can signal a potential reversal. This, for example, was happening up here. Bitcoin was moving to the upside, it was going into all-time highs, and then we finally had a spike in selling volume, indicating that this trend to the upside might come to an end. We can monitor the market sentiment. So volume provides insights into the emotions and psychology of market participants, such as fear and greed. For example, down here, we can see we've had a nice drop and we can see a massive increase in selling. That means if we pair that with more technical analysis, which we should always do, so we should pair volume analysis with classical technical analysis. That is what's giving you the secret recipe to success in trading. And here we can see it ended in a liquidity grab. And in terms of psychology, this shows that there was a lot of fear in the markets down here. Many people were selling down here, thinking that Bitcoin is going to crash, and all we did was move to the upside again. So this was just a very quick look on volume analysis using two very simple tools. That was the fixed range tool and the volume bar down here. Now let's have a look at avoiding common mistakes in volume analysis. So one thing we should definitely not do is ignore context. So don't focus solely on volume without considering the overall market context. For me, it's always context is the most important. With context against me, I'm not even looking at the volume confirmation to take a trade. It's always going to be context, then the technical levels, and then including the volume analysis. It is very common that people misinterpret low volume. So low volume doesn't always indicate weakness. Consider asset and market conditions. Also, what you don't want to do is, for example, compare the overall volume on Bitcoin with another altcoin, for example. So there's going to be more volume being traded on Bitcoin than on other altcoins. So it is very helpful and actually essential that you learn the criteria of each and every coin you are trading, because the volume on Bitcoin is completely different to our other altcoins we like to trade. And also, we should not overemphasize volume spikes. Not all volume spikes are significant. Sometimes they result from large trades or unusual events. Sometimes we have economic releases that end in a very large spike in volume. But that is something that you will learn practicing over a long term and having a lot of exposure to the markets by a lot of screen time. So this comes with experience, and I am sure you will get a feeling for when a volume spike is significant and when it's not too helpful for your trading. So I hope I was able to help you incorporate volume analysis into your everyday trading. This is such an important topic which I am very fascinated about, and that's why in the next lesson I'm going to teach you or show you an introduction to order flow analysis. So stick around and see you in the next one. Did you know that even the best traders in the world lose trades? Their secret to success is not trying to avoid losses. Their secret to success is trying to manage these losses. In this video, I'll be explaining you the importance of a risk management system, and with that ensure that you can succeed in the long term. So now let's have a look at risk management. The definition of risk management is that it involves identifying, assessing, and controlling the potential losses in trading to protect your capital. Because let me tell you something, in trading, losses are unavoidable. Everyone is going to take losses. We just have to make sure that these losses do not impact our long-term sustainability in trading. The goal is to minimize losses while maximizing potential gains. This is what I previously explained with the risk to reward. This is ensuring that no single trade or series of trades can wipe out your trading account. Because what some people do is just take on too much risk that once they lose a trade, this can infect their entire trading account and wipe out an account with one single trade. And that is something you should avoid at all costs. So proper risk management is the foundation of sustainable trading. Without it, even the best strategy can lead to significant losses. So the primary purpose of risk management is to protect your capital, ensuring that you can continue trading even after losses. Trading is a marathon. It's not a sprint. So what we have to ensure is that we can sustain in trading even after a series of losses, and that this is not going to affect our long-term sustainability. Even a series of losses should not affect you mentally, and also your account balance shouldn't be affected too much if a risk management strategy is applied. We want to survive these losing streaks, so effective risk management allows traders to survive inevitable losing streaks. So even myself, I'm trading for over 5 years, but I will experience losing streaks. That is very normal in trading, but I have to be prepared, and my risk management has to be on point that these losing streaks are not going to wipe out my trading account. So let's now have a look at the core concepts in risk management. So one thing you always have to be aware of is the risk per trade. So you want to determine the percentage of your capital you are willing to risk on a single trade. So for me, for example, that is going to 1 or 2% of my entire trading account. So let's just say, for example, I want to take a long trade on Bitcoin down here. This is going to be my stop loss. I have identified a stop loss of 3%. Now I have to adjust my position size in a way that when I get stopped out of this trade, I am not risking more than 1 to 2% of my trading account. So let's have a look at a simple example and say we have a $10,000 trading account. Okay, so $10,000 in the trading account. If we risk 1% of this, that means for each and every trade, we should not risk more than $100, because $100 is 1% of this 10,000. So in this entire zone down here, if we are stopped out of this trade, the maximum loss should be minus $100. And this is something you have to be aware of, because you have to adjust your position size according to this. Say, for example, you're trading on a very large position size. This can mean that you can wipe out your entire account if the position size is not correctly chosen. One thing which a proper risk management can help with is reducing emotional stress. By managing risk, traders can reduce emotional stress and make more rational, objective decisions. So say, for example, you're taking a trade and you are in fear that this trade, if you're losing this trade, it can wipe out your entire account. You will be much more stressed as opposed to knowing the maximum loss is going to be $100, which is 1% of my trading account. That is not the end of the world. It's not going to affect me over the next days. So this is something that you have to take into consideration when it comes to trading, because the emotional stress is something we should not underestimate. And in order for us to achieve that we only going to lose this amount, we should obviously have a stop loss order. So down here, I have to place a stop loss, because if I'm not placing a stop loss and price is just continuing to drop and moving lower and lower without a stop loss, my even predefined risk, because I wanted to close this trade down here, but I didn't because I didn't place a stop loss order, my loss is just going to increase and increase and increase over time. And then you will get to a point where you're like, yeah, should I now just stay in this trade? Should I close this trade down here for a much larger drop? Or should I wait for price to reverse? Maybe I can get out at break even. This is something you want to avoid at all costs. Let's have a look at how to avoid common pitfalls in your risk management. So, ignoring stop loss orders is one of the worst things you can do. So what you want to make sure is that whenever you place a trade, there is a stop loss in place and you do not want to move the stop loss. The only thing you are allowed to do is to trail your stop loss higher to reduce the risk. But what you don't want to see is price moving towards your stop loss and you are thinking, oh, I don't want to be stopped out of this trade, so I'm just going to adjust my stop loss. That is nothing you want to do, and this is something that should be avoided at all costs. Another thing in risk management is over trading. So taking too many trades or risking too much capital can increase exposure and lead to burnout and mental stress. So we don't want to over trade. Maybe it even makes sense to set a trade limit per day. So for example, when starting out, a good trade limit per day is 3 trades. That ensures that you won't take too many losses, but that also ensures that you will be very selective with your trades because you already know when entering a trade that you only have 2 left. So 3 trades max per day is something one can start with. So now let's have a step-by-step look into how to implement a risk management plan. So step 1 is define your risk tolerance based on your trading goals and capitals. This risk management is different for each and every one of you because each and every one has a different capital, so we should use a different risk management strategy. Step 2 is create clear rules for position sizing, stop loss levels, and risk to reward levels. Step 3 is monitor and review your risk management plan regularly to ensure it remains effective. Now, let me explain this point because it's very, very important and might be confusing. So say, for example, you started on a $10,000 trading account. That means 1% risk is 100, as we already saw previously. But now let's say, unfortunately, you've taken some losses and your trading account is now sitting at $5,000. So that means your risk per trade should be adjusted to $50 risk per trade. Because if you're still trading with $100 risk, that is double the amount of risk according or in relation to your account balance. Now for the positive part, or for the best case scenario, this can be, say for example, you doubled your account from 10,000 to 20,000. Now you can allow yourself to risk a little bit more. That is going to allow you to have exponential growth over time, because whenever you double the risk, the potential reward is also going to be doubled. So this is why some P&Ls can have these exponential increase. Okay, this is very important and something you want to check regularly. For me, for example, I'm doing that on a weekly basis. And step number 4 is stay disciplined and follow your plan consistently, even during winning or losing streaks. So something some people struggle with is that even on a winning streak, you should not increase your risk. So you might feel hyped, you have taken very good trades, you are on 10 wins in a row, but that doesn't mean you should increase your risk. You should stay very strict with your risk, and even when I'm on a very large winning streak, I'm taking a break because I don't want to get greedy and I want to apply good risk management. So this is one of the formulas that I have created for myself. And to summarize, risk management is a critical component of trading that helps protect your capital, reduce emotional stress, and ensure long-term success in trading. So I hope you can follow a good risk management strategy to ensure your long-term success in trading. So I hope you now understand the importance of risk management in trading. And if you are already a more experienced trader, maybe to reflect on your own risk management system. This is what's going to ensure your long-term success in trading. As you know, I'll be delivering 2 of these videos every week, so stick around, follow and like these videos to not miss the next ones. Goodbye. Leverage. I'm sure you've heard this term before. This is what can turn small moves into big profits or big losses. In this video, I'll break down how to properly use leverage and keep risk management in mind. This is going to be such an important video because that is how you ensure to use leverage sensibly without risking too much money. So stick around and enjoy the video. So what is leverage and why is it so popular, especially among newer traders? Leverage allows traders to control a larger position in the market with a smaller amount of capital by borrowing funds from the broker. For example, when using a 10x leverage. Okay, this means, for example, even when we only have $1,000 in the trading account, we can open a position that is 10x this 1,000. Okay, so this means we can control a $10,000 position with only $1,000 funds in our account. This can obviously increase our profit. So even with a smaller move, we can make 10x the amount of money we would do on a typical account size, which we are only using for $1,000, for example. But that, unfortunately, doesn't just include the potential profits. That also includes the potential losses. So our loss is also going to be 10 times bigger than on a normal position size. Let's say, for example, I want to take a long trade on Bitcoin. This is about a 10% increase to the upside, which I would be expecting for this trade. So that means on my $1,000 account, a 10% increase would be $100 profit. Now, when it comes to leverage, I'm borrowing from my exchange. So if I'm using a 10x leverage, I'm not opening a $1,000 position down here. I'm opening a $10,000 position. And that means my 10% expected profit is going to be $1,000 profit, even with a small account size. So to summarize, leverage amplifies potential profits, enabling traders to make significant gains from small price movements. This is one way you can use leverage, but you have to be very careful with this, as that is obviously increasing your risk as well. So let me explain you how I am using leverage, which is not like most newer traders use it. Say, for example, I want to take 3 trades across altcoins. So I want to take 1 trade on Bitcoin, 1 on Ethereum, 1 on Solana. If I only have a $1,000 account, I have to split this across 3 trades. Now, when I'm using leverage, that allows me to use a very low margin, but still being able to expose myself to 3 different trades. Okay, so that helps me to manage my margin in terms of being able to trade different assets at the same time without having this entire margin in one single trade. Now, what I always make sure is that with leverage, I'm not trying to increase my account size. I'm just trying to split the margin effectively, as opposed to trying to increase my $1,000 account to a $100,000 account, because we can also use a 100x leverage, which I would definitely not advise you to do. But this is the only reason I would use leverage. This comes down to the capital efficiency. So it frees up capital to be used in other trades or investments, improving the overall efficiency of your trading portfolio. This is the best use case for leverage. It's not to increase your position size, it's just to free up capital to put into work on different assets. Opportunities in low volatile markets, this is also where we can use leverage. So if a market is very slow, leverage can help us to at least gain something out of the scalp trade. So for the lower, very low time frame trades. If you want to look at the futures real quick, so on futures, because the moves are actually very small, there is a very large default leverage even. Whenever we are trading futures, this is going to be on a leveraged position, but different than on crypto, you don't have to manage that yourself. So the broker or your exchange is already having a default leverage for futures trading. So you don't even have to be involved in that. So what do traders need to be careful about when it comes to leverage? Just as leverage can magnify gains, it can also amplify losses, potentially leading to substantial financial damage. Besides that, we have to be aware of margin calls. So if a trade moves against you and your account balance falls below your required margin, your broker may issue a margin call requiring you to add more funds or close your position. This is something you definitely not want to experience ever. Also, we have to be aware of risk of over leveraging. Using too much leverage can quickly deplete your capital, because if a trade is going against you on a very high leverage, this is just going to amplify your losses. And especially during volatile market conditions, this is something you want to avoid at all costs. It also has a very large emotional impact. So the amplified stakes of leverage trading can lead to emotional decision making, increasing the risk of mistakes. So when you find yourself in a leverage position that is going against you, if you are in a long trade here on Bitcoin, for example, this can lead to making bad decisions and even adding to the position, because you start to get nervous that this position is going against you and your loss is going to be much bigger than you should risk on a small account size. So how can you manage leverage effectively? I already explained to you how I am using leverage to free up capital, but one thing I can recommend you as well is start small. Use low levels of leverage. So you don't even have to use a 10x leverage. Why don't you start on a 2x leverage? This is very conservative, and this is how to get used to using leverage. Also, we want to use stop loss orders. This is something I already explained in the risk management lesson, but setting stop loss orders is even more essential when it comes to leverage trading. Also, we should monitor margin levels regularly. So every day, whenever we're taking a trade, we should be aware of the margin that is necessary. Okay, so regularly check your margin levels to avoid margin calls. And what we want to avoid is over leveraging. So don't ever use the maximum leverage available. Instead, tailor your leverage to your risk tolerance and your trading strategy. So to summarize, leverage can be a very powerful tool that can enhance profits if applied correctly, but it also carries a significant risk. It's essential to use leverage cautiously and always prioritize risk management. So I hope you could learn something in this video and now understand how to incorporate leverage into your trading without risking too much money. Because believe it or not, but leverage is the one tool that leads to so many traders, especially beginner traders, who fail. So stick around, because I'll be delivering 2 of these videos every week to try and elevate your trading journey. See you in the next one, and goodbye. So you have taken the first steps in trading, but what comes next? Trading is a marathon and not a sprint. Now it's all about having the right expectations and managing these expectations to ensure long-term profitability in trading. In this video, I'll break down what to expect from your trading journey going forward. So enjoy this video. So what can you now expect from your trading journey? The most important thing is setting realistic expectations and understanding that trading is not an overnight success. Okay, so let's have a look at some common myths and misconceptions. So there's something many people think, and that is that trading is a get-rich-quick scheme. So many traders believe they can quickly make a fortune, but trading is not a shortcut to wealth. It actually takes a long time, and it is a journey. So also a misconception is constant wins. So the idea that successful traders win all the time is a myth. Losses are a part of trading, even for the best traders. So let's have a look at this. For example, today I did take a nice trade on SUI. That was a winning trade, but at the same time, I've taken a loss on Solana. This is very normal. This is part of trading. I've been within my risk management, so it's nothing that's going to affect me over the long term, but it is normal to take losses. And also, trading is not easy money. So trading is often portrayed as easy, but it requires significant time, effort, and skill development. So the skill of trading comes with a lot of screen time. So it takes a lot of time, but let me also encourage you. So it is possible. simple, it just takes a lot of time. And instant expertise. So many people think that they become successful traders overnight, and that's not true. It does require continuous learning and experience. Even for myself, I'm always open to learning more. I'm never going to reach a state where I can't learn anything about trading, so it's a constant improvement, and I have to be open to the idea of constantly learning. So we have to set realistic expectations, and that means the initial learning curve is expected to be very slow. So in the beginning, there's considerable time needed to learn the basics and making mistakes in the beginning. So that is why I wanted to bring this beginner series to help you at least fast track this for a little bit. We should focus on small gains at first. So profits in the early stages may be small, and losses may outweigh your gains as you learn. That is absolutely normal. So most traders lose in the beginning. That is something I did myself. I didn't start out trading with making money. I actually lost money in the beginning, and I had to develop the skill of trading first. Also, according to the trading psychology the video I've done previously, there's going to be emotional challenges. So be prepared for emotional ups and downs that come with wins and losses. And also, let's highlight why patience and persistence are key in trading. So success in trading often comes with time. For me, for example, it took about 2 years. So we have to focus on consistent improvement rather than quick wins. We don't want to succeed in trading overnight. We want to look at the long term and achieve profitability in the long run. We have to handle setbacks. So every trader experiences losses and setbacks, like the one trade here on Solana that I showed you. The key is to learn from them and keep moving forward. That's why a trading journal can be so helpful. And trading requires the development of a variety of skills. So from technical analysis to risk management, and that obviously takes time. Trading is a very complex topic. So I was trying to break it down to some very helpful beginner series lessons, but obviously there's so much more to learn about trading. We have to stay disciplined, and that means maintaining discipline in following your trading plan. So even when results are not immediate, it's crucial to do it over and over and over again. So our goal should be the longevity in trading, and that takes a consistent strategy. So developing a trading strategy that works for you and sticking with it through different market conditions. Continuous learning, as I already said, markets evolve and so should your skills. So stay curious and keep learning new techniques and strategies. For me, for example, nowadays I'm not using the same strategy I've been using years back. So I have to develop new strategies according to new market environments. And also adapting to change. So successful traders are flexible and adapt their strategies as markets change over time. And one very popular thing for that is we can trade a bull market or a bear market, and the strategy has to be slightly different, right? So we have to be open to market dynamics, we have to be open to markets that are changing and adapt our strategies accordingly. One very important thing for all of that is setting realistic goals. So we want to start small. We focus on learning and refining our skills rather than making large profits early on. That is why demo trading can be so helpful. We also want to track the progress, set goals around process improvement, such as refining your strategy or mastering risk management. And for that, for example, I have implemented something that I am doing weekly, monthly, and yearly reviews with myself, where I'm tracking my trading progress to see, have I improved in relation to the previous week, to the previous month, to the previous year, because I constantly want to get better. And as traders, you always want to think long-term. So set long-term goals, like becoming a consistent profitable trader over the next 2 to 5 years. You don't want to be a profitable trader within the next week. Set yourself realistic goals, like having a better win rate, then working on risk management, working on risk to reward, and then eventually set yourself the goal of becoming a profitable trader. So let's have a look at the mindset of a successful trader, and that is embrace learning. Treat every day as a learning opportunity and don't be afraid to make mistakes. We all gonna make them. You should rather enjoy it as opposed to feeling upset when making mistakes. And stay detached, so avoid getting too emotionally attached to trades. Focus on execution and not outcomes. Our job as traders is to take one good trade and then one good trade and then one good trade. We should forget about the trades that we've taken previously and stay detached from all of our trades. We have to focus on the process, and that means prioritize following your strategy and managing risk over the results of individual trades. And one very important thing is being resilient. So trading can be mentally challenging, but staying resilient in the face of losses is key to long-term success. So to summarize, setting realistic expectations and focusing on long-term growth is essential for a successful trading journey. Patience, persistence, and the right mindset are your greatest assets. And let me tell you, it is a very, very eventful, exciting, and amazing journey. So I can only encourage you to walk this way, so you will learn so much about the markets, but also about yourself. So I hope this video was insightful to you and you now know what to expect from your trading journey going forward. There's gonna be one more beginner series lesson that I will be releasing on this channel. So make sure to hit the follow button, like, and see you in the next video. Goodbye.